People tend to talk about the VIX. That is a way to express volatility. And if there is anybody in the industry who knows that better than Andrew Thrasher, I don't know. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angi Kinser.
Happy to have you along, Angie. And hey, we've got a special guest from our Fisher's office, Andrew Thrasher, joining us. And happy to have you along. Andrew is an expert, if you will, in terms of volatility. Best way I know how to put it. So I'm going to turn it over to you, Angie, for you to ask him questions.
Okay.
But Andrew, glad to have you.
So your topic is going to be bulls and bears, keeping your emotions in check during uncomfortable swings in the market that could help you win the big game. So first question, during a sharp market decline, what do you suggest for those who had planned to withdraw a large amount for a big purchase?
If we were to see a large market decline, I think you have to always have to look at your time frame when you're investing, and if you're needing money within the next couple months or so, then maybe having a lot of equity risk is something that you should be taking into consideration. Always wanting to look at kind of the worst case scenario of what could happen. And now we kind of, after last year, we kind of have played out a worst case scenario after last March, where you see stocks have kind of a waterfall-like decline. And so something that we often talk with our clients about is looking at their full plan and their full picture in discussing when they have distributions that may need to be made and trying to make those decisions before you absolutely have to, before you have maybe a down payment on a house or whatever it may be in 2 weeks, and you're now in maybe a bad market environment. And so really to try to plan ahead, maybe start pulling in some of that cash ahead of time when the markets aren't really volatile or aren't really declining too much. So then you don't have to make those real emotional decisions in tough market environments.
Does a drop in the market automatically mean it's a bear market, or how's that determined?
Bear and bull markets, something that's much more beloved by the media than by people that actually do this for a living. So the way that they define technically a bull or a bear market is when it goes down 20%. Down 20% gets you a bear market. The thing is that, and what a lot of people get confused is individual stocks don't have bear markets. Markets have bear markets. If Apple were to fall 21%, and then rise the next day 21%. It didn't just go from a bear market back to a bull market. And so these are just ways people try to define, or mostly in the media try to define market environments. But traditionally, it's a 20% decline and then a 20% advance is how you define a bull and a bear. And that comes from a bear kind of claws down, and a bull will use its horn and kind of buck up, and that's where you get the nomenclature with the animals.
Okay, so this is critical. So let's go back to his first answer, right? Probably your second answer is the most, I almost use the word prophetic. I don't want to do that. But the second answer that Andrew gave is most critical. The media will try to cast a market in a certain light. So a 20% decline is what they call a bear market, and a 10% decline is what they call a contraction. But as Andrew pointed out, and as you should be thinking about your portfolio, individual investments don't have that. Markets do. So when you look at what we do at FEG, we don't necessarily look at either of those two as any indicator of what is going on. We're looking at the actual market. So great way of putting that out, Andrew, and I'm happy about that.
Andrew, normally we're advised to wait out, a volatile stretch. Does that mean there's never a time to cut your losses?
No, I think you have to have some pain point identified to where you have to be able to sleep well at night and not constantly worrying about your portfolio. If you're choosing to do it yourself, then that's really a decision that you have to make personally. If you hire a professional asset manager, have an advisor, then that's a conversation that you get to have with someone else who's not as emotionally invested in your account as you are, because they're able to have a rational professional look at it. So I think it is, if you can say, what, my pain point is X amount of dollars, And I think it's important to look at it from a dollar standpoint than maybe a percentage, really grasp what's being lost and say, this is the point where I absolutely need to make a decision on, can I lose any more? And that conversation is to be had in your whole scope of your portfolio. What's your objective for that account? If you're not retiring for another 30 years, then you can likely withstand a little bit more volatility than maybe someone that's retiring next year. But ideally, you want to be able to have those conversations before the volatility comes in, before the market declines. Be prepared, have a plan. So then when the market does decline, as it's going to do, that's normal, you're just executing a plan you've already put in place versus trying to call an audible from the field, to stick with your football theme,
Yes.
when kind of things are going crazy, like last March or 2008 or what have you.
So going back to your first point, and I think it's critical, and you've got to take this away. And Angie, it was a great question. It is an understanding of when you need to use money. You can't time the market any more than I can, Adam can, or Andrew can. That's not our job. Andrew looks for indications that says, hey, something is going in the wrong direction. But if you really need to use capital, you have that in a short-term period of time. So we're talking 90 to 180 days. You have no business being invested in the equity market, right? I mean, you simply don't. And so it's, so as the professor in me, the financial planner in me has to contrast what Andrew just said. Yes, the younger you are, in theory, the more volatility that you can take. He is 20 years younger than we are, right? In theory, he can accept more volatility because the market should recover over 2 decades that you and I don't necessarily have, you and I being me and Angie. But that's not how emotions work. We tend to respond over an 18-month period of time. I am adamant, and that's why Andrew's part of our team, and I'm very thankful for that. I am adamant that having market technicians, people who look at the market in a shorter term period of time, who simply don't say buy and hold, matter to our results. And I think our returns are indicative of that.
Well, in talking about that phase of finance and your risk that you're willing to take, how often should you do a risk assessment test?
I think when you have major life changes, you need to reassess that. For instance, my wife and I are expecting our first child next summer. We'll probably be redoing a risk assessment after we now have a child. If you have a major change where you've left a job, or you had a change in your family or family financials, anytime I think you have a major change in your life, whether it's emotional, it's actual human beings, if it maybe a spouse has passed, or anything that's really had a large impact on your life, you need to reevaluate and assess is not just your risk, but kind of what your goals are, and kind of have that timeout period to determine, do you need to shift your path, and whether it has an impact on your portfolio or not.
Okay, so we have a shorter term period that I would like to have for this, but this is a great question that we had with Ben Hardy, author of Willpower Doesn't Work, Who Not How. So, Andrew, do you believe you can accurately fill out a risk tolerance test?
You mean the average person? Can the average person fill out a risk tolerance test?
No. I'm talking about you, brother.
Could I accurately fill out a risk tolerance test?
Yeah. I'm the one who will take a bullet if something happens to you. I'll stand in front of you before the gun hits you. You know that. So now I'm asking you, because at some point in time, something happens to me. Everything I have has to stay at FEG. That's part by contract. That means you're taking care of my family when I'm no longer here. Do you really believe that people can accurately fill out risk tolerance tests?
Oh, no. I think when they're in the heat of battle, I think everything changes.
Yeah. So that's the whole point that I would try to make. Emotionally, people fluctuate. I mean, he just said, well, arguably, one of the biggest events you can have in somebody's life is having a child, right? Getting married 32 years ago, having my 2 daughters, losing a parent, retiring from work. And, those are all those things. And so you can say, well, you should fill out a new test. I think that's industry And I'm not going to give you industry stuff on this radio show. I just refuse to do it.
Okay, Andrew won an award, right?
Yes,
the
he did.
Charles Dow Award in 2017. In your paper, Andrew, Forecasting a Volatility Tsunami, by the way, you say that there are ways better to identify a market environment that often leads to large moves in volatility. Can you describe what that means?
I'm sure I'll try to kind of boil it down into a short of a time period as I can. What I found is studying volatility. Volatility rises typically when the market goes down. And so as a portfolio manager, I want to understand when maybe there's a higher risk of volatility entering the market and the market potentially be going lower. And so I found that when the standard deviation of the volatility that we can measure, kind of the ups and downs, daily ups and downs of the VIX, which is the gauge for volatility, when it starts to get really, really low, meaning volatility is really not moving a lot, not going up or down, that kind of creates kind of an overconfidence that there's not a lot of movement, there's not a lot of activity, and that overconfidence is what kind of breeds. Then you have these big spikes in volatility. And typically going back all the way before we even had the VIX was created, go back all the way to the 80s, even before the 87 crash, just about before every single spike in volatility, we see this really tight compression in volatility. And that's what I found, that this creates an environment for the VIX to spike. And that's what my paper was about. Going into a lot more detail, of course, looking at the math and everything. But typically when volatility gets really compressed, it's like holding a beach ball underwater. Eventually, when you let it go, it shoots up really high out of the water and spikes up and gets everybody wet. Same type of thing. Volatility spikes up and causes a little bit of chaos.
You know, as quickly as that was really a great explanation. And if you want more, email us or call Angi at 800-928-4001. We'll take a break. Andrew, thank you for being here, buddy. Be well.
Yeah, appreciate it.